Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, back here on the Investor Coaching Show, Paul Winkler, Evan Barnard, talking about money and investing. So, the ex-Goldman Sachs CEO was on CNBC this week, had a lot of interesting things to say. So one of the things that we talk about from time to time here, we're talking about, market downturns. When is the next one going to happen? Nobody knows, right? You can't predict this type of stuff. You could predict you'd just be in when the market was going up, and you would be out when the market's going down, right? Just before it goes down, you get out and avoid all of this stuff. Now, we were just talking a little bit about credit spreads. We were talking about insurance companies taking lots of risks and just stepping out there and taking a walk on the wild side. And when is that going to come crashing down? Nobody really knows. But that was the topic of conversation, is when is the next crisis going to happen? But this is what's so interesting about it is I just like his take, and I want you to hear when he talks about, especially at the end of this clip, what do you do about it? As an investor, what do you do about it?
But do you say to yourself, though, these are sort of 1% risks, and otherwise, as you said, we're in this benign environment, which I think you're saying is a bullish environment and continues apace? Or do you say
there's a lot of 1% risk, but it's not a 1% risk that something bad will happen. It always look. We had, roughly the crisis of the century, roughly every 4 or 5 years. Debt crisis, emerging debt crisis in 1994, big crisis 1998, long-term capital and the Russia debt default, dot-com bubble 2000, 2001, 2000.
Just as he's going through that, Evan, what goes through your mind? When you say he's naming all of these things.
Well, initially, I think it's nothing new. Volatility is nothing new.
Yes.
And in the midst of all of those things, and he may continue with the list, long-term equities have still maintained beating inflation by about 7% per year.
Yeah.
Net of all that stuff. So
you go through all those types of things, and you just do whatever you can to try to avoid those things that you think that'll be helpful to you.
Yeah.
And what ends up happening is you end up missing the upturns that occur usually fairly rapidly after. But the other thing that hits me is how do we forget that this stuff happens? It's almost like we get into this complacency.
Right.
Everything is going to be great.
No client has come up asking if we're going to shift the policy based on the Russian debt default in 98 or something,
Right. It's not on people's radar screen.
Right.
And then, and people get bullish and they get out there and they start investing and they get a little bit of success and they think, wow, this is so easy. And that's where I think people are right now. This is so easy. And they forget how frequently these bad things happen. So he's just naming through these terrible things that have happened.
Quick learners. We're kind of,
or are you saying we're due?
I'm saying we're due.
Slow learning.
And it doesn't matter that you can't see from where it's coming from. Now, having said that, the other thing I used to ask people all the time is, it's so, you sound so much smarter when you're bearish.
I think that is very true, what he just said right there.
Yes,
I want to stop it.
I would agree.
You sound so prudent when you're the person saying, wow, this is going to be happening, this is what's going to happen. You sound like an idiot when you're bullish. And that is partly why people respond so well to fear. That's how investments are sold so often. Well, you got to have this annuity over here to protect. And, you don't recognize the risks that the insurance companies are taking because they don't have to declare the risks quite as readily as regular investment market participants do. The insurance companies get a pass. Guaranteed. They have guaranteed. They do have to put in the fine print based on the claims paying ability of the insurance company. But who reads the fine print? Really.
We do. And I used to say, what do you think? And then I said,
that's right.
What are you? How are you positioned? And, I have all these bearish thoughts, but I'm 100% in equities.
There you go. And isn't that interesting what he just said there?
Yeah.
I have all these bearish thoughts, but what am I doing? I'm in equities. So recognize that you may be hearing, and I've seen people do this before, they'll say one thing and they're doing just the opposite, what they're really doing. But they'll be talking about how you should be managing your money right now. And they sound sounds prudent. But what are they actually doing? A lot of times it's not what they're saying. Remember that little hidden it was like it wasn't a hidden camera.
In the documentary?
It was a documentary. And remember they had that media journalist and they were silhouetted.
Oh.
And it was talking about, during the daytime, we talk about all of this stuff. But, secretly what we're doing is that's not how we're managing our own money. And I heard this thought, wow.
Well, just as you were describing that, I can't even picture what that ad or meme or whatever is, but the Saturday Night Live skit from
right.
2001 or whenever that was.
It's a great time to invest.
Came up and, well, what were you, you were selling bonds, or what were you? Well, we were buying those, It's like, we just sold you those things.
The group one. The group one.
Yeah.
Yes.
And like, okay, whatever.
That was funny. Yeah, this guy is doing a workshop, is basically what Evan's talking about. And he's saying one thing, and they're going, well, weren't you just saying this over here? And, people in the audience are picking up that he's contradicting himself over and over again, and it didn't seem to bother him at all. That was the funny thing. So we look at, this, and we hear the government default talking about short and long-term interest rates and things like that, and this is an interesting little piece as well.
You can always print dollars, so you'll always be able to pay back dollars. How does the U.S. government default? It defaults by inflating the currency so that the dollars it pays back aren't worth as much.
There you go.
Well, if you evolve to a position where it looks like we're going to inflate the currency.
That's by the way, that's what Warren Buffett basically said. He wasn't worried about the federal debt because he said, we'll just print our way out of it, is basically what he's been noted as saying.
That's like telegraphing to the market that I'm much more likely to default than you had previously thought. Well, if you're likely to default, I'm either not going to lend to you or I'm going to charge you a higher interest rate. Mm-hmm. That's why when everybody wants interest rates lower, mortgages and long-term interest rates low, lowering short-term rates might not get you there. It might suggest to people more of a tolerance for inflation, and therefore higher interest rates in the future. So I think this Fed independence, protecting the dollar, the currency, the integrity that you...
So this is important. So if, and this is the big debate, is lowering short-term interest rates, is it warranted? Is the inflation rate too high, or is future inflation too high? Is it a risk to do that? And I think that that's incredibly debatable, but I just want you to get the point he's saying right here. Just in terms of short-term interest rates, it's something I've said over and over again, that the Federal Reserve does not control long-term interest rates. But they've got to get it right, because if they lower the short-term interest rates and all of a sudden inflation takes place, the long-term interest rates are going to go up. Your mortgages, the cost for your mortgage is actually going to go up. It's not going to go down. It's just the opposite. And a lot of people don't quite get that it is not the short-term interest rate that actually controls those things that people are so worried about. They think, if we just do this, if we just lower the short-term interest rates, then my cost to borrow to buy a house and all of those things, then life is just going to become lovely. That's not the way it works. And it actually could cause the opposite. Now, this guy, he may be on the side of thinking that inflation is going to become a big problem. I don't know. I'm agnostic. It's too hard to know whether that's going to be the case or not, at this point, because you keep getting this data that comes in and you're thinking, the tariffs are going to be, it's going to be inflationary. It hasn't happened yet. Will it happen? Who the heck knows? I mean, you got other things that are countervailing things that are happening out there. Like, for example, AI is bringing down the costs, and you've seen the data coming in regarding employment. And you have a lot of people that are getting displaced as a result of that. Will they move into other jobs? Will they create more demand for employment someplace else? Will that mitigate it? Is there the fact that we have a reducing birth rate in the country? Is that going to be something that could be causing some problems? You've got oil prices coming down. Energy prices have been dropping. So therefore, that has actually come against any kind of a move toward more inflation. So there are a lot of things that it just makes it really, really hard to figure out what's actually going to happen. Are we actually going to be dealing with inflation? That's a big question. Because, and if it weren't, we wouldn't be debating it if it were so easy. It's not. That's an incredibly hard job trying to figure out what to do. But keep in mind, here's what's important. Here's what I always try to remind people of. The Fed is just one little entity out there messing around with interest rates. Their job is to make sure that the currency stays stable. And yes, inflation is one of the ways we do that. And they've done a fairly decent job, if we've looked back at the history and people say, well, it's that, all the problems with the Fed and blah, blah, blah. But, they've had some missteps. Who hasn't in life? But they've done a fairly decent job of doing that and full employment. And that is really what's going on right now is they're dealing with two things. And a lot of those issues are not just driven by what the Fed does with short-term interest rates. A lot of it's government policy. I mean, maybe that's who we ought to be holding accountable for some of the things that are going wrong. Because there are bureaucrats that do things that are not necessarily in everybody's interest, their own interest, that cause some of these problems in the first place. So, and the other thing that I want to do is I want to take a break and I want to get into something. I want to leave myself time for this. But there was a guy that was out there, and I've gotten this thing into YouTube, Evan, where I'm getting all of these videos. Yeah. People trying to hawk investments. Right. And what do we call those things? Finfluencers. Finfluencers. People that are getting paid. I didn't even know they existed till last week. I know. We had our compliance attorney talk about finfluencers. They're financial influencers trying to get you to do things with your money, and you don't necessarily recognize when they have a conflict of interest. They're getting paid to get you to do this stuff. And they're advertising for investment products. So I've got a good one right after this. You got to wait. You got to wait for this one. This is really good. Paul Winkler, Investor Coaching Show, along with Evan Barner. We'll be back right after. Hey, just a note to you podcast folks. We just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement. Real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right. Man. I get ornery like this and the hour goes fast. Time flies when you're having fun, brother. I just like warning people about stuff that they really ought to know about. It hacks me off when I see investment companies get away with the stuff that they do. And I thought it would get better. I really did. 25 years ago when I started this radio show, I thought it was going to get better. And it has only gotten worse. Like we were talking about this newsletter where I was talking about the active professional managers not matching market returns. And, the compliance company wanted to know what the data was. Where did you guys get the data? Because I said that most investment managers are actually using this style of management. And they said, well, where'd you get that data? And there was an article. And it was like 3/4, something like that. I think it was 3/4 of investment managers claimed that they were using, and it was a study done a couple of years ago, that they were actually using actively managed mutual funds, stock picking, market timing, funds that were engaging in those activities that we've for 25 years said, foolish, don't do this on this show. It doesn't work. Studies are replete that it doesn't work. So, and I was talking to Michael about this, and I says, hey, wait a minute. Because I think the 25% that don't do it, I think that's even high. And he says, yeah, what would you use there? And I says, well, remember that study that we talked about here on the radio show a few months ago? And it was about index funds. And I'm not a fan of index funds in most areas of the market because they overweight bigger companies. And indexing is there's a closet aspect of active management because the indexer, the company sponsoring the index, whether it's Standard & Poor's, whether it's Russell, whether it's, MSCI or whoever, they're actually choosing which stocks go into the index. So there is a stock selection, but it's not as active right? Well, the study was showing that in the top 10 of most actively managed assets, as far as what's actively managed, buying and selling and trading stocks, no, indexes were. So some of the most actively managed assets out there were indexes, which were designed to be passive. So I pointed that out to Michael. I says, hey, if you need any more ammunition, here you go. This is it. I told him about that study. So this guy, I guess I'm in the bullseye. I have, when I go out there on YouTube, I actually see these types of ads out there, and I don't know if this is a finfluencer or what it is, but this person talking about the only ETF, the only exchange traded fund you need. This is the only one. You ready, Evan? Take notes, man. This is the only one that you need, right?
Let me get my pen.
Is that you watch my channel, but not just because you follow blindly with what I say.
Now, who does that sound like? That's what I always say. Don't blindly trust me. So he comes off sounding good out of the gate. And I believe that. I agree with that. Don't blindly trust anybody.
But that you actually want to learn and better yourself. I'm not going to hold you hostage and wait until the middle of this video to actually let you know what this ETF is. I'm going to go ahead and tell you right up front. But my hope is that you're not just someone who hears the ETF name, then goes and buys it. My hope is that you watch the video and form your own ideas about this ETF and that it starts your research off for you. I know for me, it's absolutely supercharging my portfolio right now. So I'll explain what this ETF is.
No, wait a minute. Go ahead, Evan.
Go ahead.
No, I think you got it. I don't think you know where I'm going. Go ahead, man.
So, if I heard correctly, the first part of his video was, this is the one ETF you need to own.
That's right.
And now it's supercharging his portfolio.
Which means he owns other stuff. Why own anything else if this thing is that great, right?
People forget that you can watch the video a second time or something. I don't know.
Unreal.
Wow.
Is give you some quick highlights so you know how it works and how it's different than almost everything else out there, where specifically it fits within the 3-fund portfolio,
and now he's got 3 funds.
Invest in it for the rest of 2025. This ETF is called the Invesco S&P 500 Momentum ETF, ticker SPMO. And when they say momentum, they really mean it. This ETF inception date is 2015, so we have 10 years of data, and on average, the fund is producing an average yearly appreciation of 18.5% since inception.
There you go. Okay, so huge return. And then he goes on to tell you how much your money would have grown to had you done this and blah, blah, blah. Momentum. The idea behind momentum, it's talked about as another factor. You have factors of investing. You got small companies versus large companies. And historically, small companies, you have a higher return than large companies over long periods of time and blah, blah, blah. And then you got value companies versus growth companies. You got stocks versus bonds. Now, one of the other factors that they talk about out there is momentum. The idea of an object in motion tending to stay in motion. If a stock's going up, it has a tendency to keep going up, right? So that's the idea. Well, the research shows that the returns, when to be gained through momentum. There was an interesting study by Kellogg School of Management had a study. There's an Arnott study on it, and they found that this is not doing well. This as a method of managing money and helping juice returns is not doing well, is what the research shows, that the cost of actually implementing momentum exceeds the expected benefit of actually doing it. So the only time that I would ever say that it would make sense is to use it to offset expenses, because it can be helpful in reducing the management expenses of an investment portfolio, but it's not good, and it's way too complicated for me to get into here. But I want you to get that that's what he's saying right there. So he's saying that this guy is saying, hey, look at what this fund has done over 10 years. Now let me just continue here for just a quick second on what he says next.
Hope this got your attention. And for those of you that actually take the time to learn why this ETF is doing what it's doing, you're going to be light years ahead of your friends very quickly.
Yeah, so appeal to people's desire to be ahead of their friends, to beat their friends, right? Okay.
My name is Nolan Gouveia. My students call me Professor G, and I made this channel.
My students call me Professor G. I don't know if he's a professor someplace, but, anyway, that's...
to make investing simplified. So the Invesco S&P 500 Momentum ETF, it's all about this idea of momentum. It basically finds the absolute best, strongest, most momentum-bearing companies within the S&P 500 and made an ETF of the 100 top momentum-filled companies.
And the people that own those companies right now really don't want any extra returns, so they're willing to sell you those companies. So that makes a whole lot of sense too.
This is why when we look at the chart of SPMO versus the S&P 500, you can see that SPMO is clearly crushing it. The light blue line is
clearly crushing it. Present tense.
S&P 500, and the dark blue line is SPMO. VU, which is the ETF that tracks the S&P 500, is up about 84% in the past 5 years. SPMO is up 130% in the past 5 years. That is a substantial difference.
Yeah, so that is a substantial. Now, here's what you don't see, because you did not see that chart, right, that he was referring to. I don't think any of you saw it. If you did,
I haven't pulled up.
do you? Okay, so here's the chart, Evan. I'll show you the chart that he had on the TV screen.
Okay,
All right,
yeah.
you got that? Okay, all right. One of the things you'd notice if you're looking at the chart is that the return of the SPMO and the S&P 500 is darn near, Evan, am I right?
Yep.
Identical for the first 8.5 years.
Yep.
Identical
Which
for the
is
first
surprising.
8.5 years. Yes. It only broke out in the last year and a half.
Yep.
So even though it sounds like he's using 10 years of data to show how great of an investment strategy this is, he literally only has something that happened to have outperformed in the past year and a half,
Yep.
when most of the academic research shows that this is something that if it does better for any period of time, it's luck. It's luck. It is not investing. And yet, you listen to that, you would swear it was the only thing that you needed to do. And it's momentum. This is sophisticated investing. Ugh. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors. And confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.